Well, thank you very much, Karen. And I'd like to thank NoBeat for the opportunity to present this information. It's really it's a blessing. It's a privilege for me to be able to share that. And I hope that everybody that's participating and everybody that will see the information will be able to benefit from it. So I guess I'll share my screen. Yeah, I guess I'm not able to share, send request. Okay, okay. Okay, so everybody sees the screen? Okay.
Yes.
Again, thank you very much for the opportunity. My name is Marc Lalonde. I'm a risk management advisor, also known as a licensed life insurance agent, working as an independent representative. And I also have another hat, if you will, which is an infinite banking concepts authorized practitioner and coach. Now, we're going to be talking about becoming your own banker today. And this is just a concept that was developed by R. Nelson Nash in the early 80s. And it's a concept. It's how to take over the banking function and how we can benefit from benefit like the banks are benefiting right now, but how can we take some of those benefits back into us personally? And that's what we'll be going through today. And specifically, we'll be looking at what could be done within your business through a corporate setting. Now, it could work for sole proprietors, but all the information that I'm going to be providing today is assuming that there's a corporate structure in place. But it is applicable to individuals, to families, to sole proprietorships, or to corporations. Today, we're concentrating on corporations. So again, a disclaimer, this presentation is to be considered as educational information only, and the topics and opinions shared do not constitute financial, legal, or investment advice. And it is always recommended to seek professional advice regarding your specific situation prior to implementing any strategies or concepts that will be presented to today. Again, that's very important. It's information purposes only. So again, we'll be looking at becoming your own banker for your business. How does that actually work? And we're going to look at three specific things. One of them is, can my business self-finance? And then sometimes we'll see that getting financing in a small business is not always easy. Second one is, can I reduce my corporate taxes and specifically due to passive income? Now, maybe not everybody's going to be able to do this, but I just want to show give a demonstration what is possible if you do have passive income within your corporation. And finally, we're going to look at preparing yourself and your business for retirement. So the current frustrations with small business financing. Now, not sure about you, but it seems that when we need money, there's none to be found. And when we don't need anybody, everybody's offering it to us. So it's having access to money when we actually need it. Sometimes that's not always obvious. Second part is collateralization. Now we've created a corporation to try and keep our personal life separate from our professional life. But unfortunately, if we're starting up, the financial institutions will actually ask for personal assets to be collateralized against any loans that we could make. So that could be an issue. Laborious application process and delays. I just have one example. I spoke to a client I spoke with. He had made a request. He's got this business wherein from January to mid-March, really slow period. So the numbers aren't quite there, and he has to struggle to find money. And he made a request for a line of credit at one of the major lending institutions in Canada. And when I spoke to him, that was 9 months later, he got no feedback from them at all. So he just needed a period of time. He made his budgets, he made his objectives the year, but that first month and a half or 2 months, 2.5 months was really difficult. So he was looking for a line of credit to bridge that, but he was not able to get that. So again, laborious application process and the delays. The banks, you don't just walk in and say, I want 50,000, and then you walk out with a check for 50,000 the same day. That's very rare. There's a long process to go through it. Also, you got the rigid repayment options. As you know, in a corporation, the financial institutions, they verify everything really close. And if they sense there's some pressure from your side, they could actually recall these loans very easily. So there could be some pressure that could be put on there as well. So you're not really in control. So is there a better way? Is it possible to use becoming your own banker, the infinite banking concept, to do your own financing? Well, actually there is, and there's two principal ways of financing through becoming your own banker. First one is policy loans, which can be available to everybody. And that's what we're going to be talking about today. And there's also the immediate financing arrangement, or IFA. Now, this is a very specific situation, and it would take me about an hour just to explain all the intricacies of this, but this is for really high net worth corporations that can be exposed to maybe a little bit more risk. So we're not going to be looking at that today. If there is anybody that would be meet the qualifications for this, it is definitely doable. But today we're going to be concentrating on policy loans, which is very straightforward and very simple. Both have their place. They're good, but we're going to be concentrating on policy loans today. So becoming your own banker for your business. We're looking at financing. So what is happening? Well, right now you've got a corporation, you're generating profit, you've got some retained earnings, and you might have a portion as well that's generating some investments that are generating some income. Now, your money is residing somewhere. It's probably your retained earnings. You probably don't have that in the filing cabinet in your office. You probably have it in some financial institution. And your assets as well, your investments, they're sitting somewhere. Well, what if you were to take a portion of that, those either retained earnings or the investments, and put it into a private banking system? Now, what is this private banking system? Well, the developer of the Becoming Your Own Banker, Nelson Nash, determined that the most efficient vehicle to be able to carry out the banking function, this could be done with, you can do it with a bank account, you can do it with CDs, you can do it, you can do it with a whole bunch of different things. But Nelson discovered that the most efficient tool that could be used to implement the infinite banking concept is a properly designed, dividend-paying, whole-life insurance contract, preferably through a mutual company. Now, some of the information I'm going to provide, you might not be aware that a life insurance contract actually provides all these benefits. So I'll just go through briefly some of the benefits. There's more to it than that, but just some of the benefits, why you'd want to do this. One of them is you maintain complete control. You are the owner of this contract. If you maintain your contractual obligations of paying your premium on a regular basis, either monthly or annual, you have complete control of this contract. It's private. It's like a contract between you and a supplier or you and a client. Nobody else is aware of that. This is a contract between the business owner and the life insurance company. No, apart from your advisor, maybe your accountant or your tax attorney, nobody else is aware of this. It's not public knowledge. The next one is the really interesting one, is tax-free growth. Now, as you're probably aware, there is no TFSA, there is no RRSP for a corporation. But with a life insurance contract, a properly designed life insurance contract that has cash value growth, that growth is deemed tax-free. Why? Because the government doesn't see it as an investment. They see it as a future replacement for a certain incident, as a life insurance contract. So it does have aspects of an investment because it does increase in value, but the government sees it that you are able to have that tax-free growth. And every dollar that goes in to this contract, you'll never touch again. It's there and it keeps growing until you take your last breath. So, and it's growing tax-free. Now, you've got this ever increasing cash value that's increasing in your private banking system. And I'm never going to touch that money. And that's the nice thing about the infinite banking concept, is I have uninterrupted compound tax-free growth within this system. I never touch my money. But the life insurance company will allow me to leverage that cash value. As an example, I'm a business owner. I need to buy a vehicle. Well, I've got two options. I could go out and finance it and make my regular payments to a financing company, to a dealership. Or if I have enough money in my private banking system, I can leverage that. I can contact the life insurance company. I say, I need $50,000 as an example. I take within 5 to 7 business days, no questions asked. They're not even going to ask me what I want it for. Within 5 to 7 business days, it's transferred into my bank account. I take that money, I go pay for the vehicle cash. Now, the payments I would have made to the lending institution, I will simply redirect back into my policy. So it's like a line of credit. Every payment that I make back frees up that money again to be used, because my money is always growing in the background. So I've got this continual growth that I'm not interrupting. I'm leveraging against it. I'm paying interest, but as soon as I repay, I actually have access to all that money. So at the end of 5 years, the whole loan is paid off and I have access to 100% of my cash value, plus all the growth that I got in that time. Zero market volatility equals no losses ever. And I'll explain to you in a few minutes. We'll see why. Every dollar that I put into this policy, or every dividend that the life insurance company will give me on a yearly basis, is vested, which means it could never, by contract, it can never go down. There is no market volatility. This is not based on the stock market. It's independent of the stock market. It has been for the past 200 years in North America. And this is the nice thing about this. I've got tax-free growth that's guaranteed to never go down. So I've got a lot of solidity, and I'm never interrupting that growth until I pass away. Also, it's life insurance, so I have protection, and I have protection at death, so I can make sure that my fiscal obligations are taken care of, because that policy would have been designed taking into account what your fiscal obligations would be at death, and also creditor protection. And it gets a little tricky on the corporate side. You want to make sure that the policy is placed in the proper area to make sure that it is protected. Typically, you wouldn't want to put this into an operating company, because then the cash value could be accessed if ever there was a legal pursuit or legal anything legal or creditors. So you'd put that in a holding company that owns that opco, so you could get a level of protection. And finally, it's infinite what else you could do with this, because if you have a pile of money that is accumulating that you can access at the drop of a hat, well, opportunities are going to hunt you down, and you'll be able to participate in those, because there isn't more credit checks. If you've got $100,000 available, you can access up to 90% of that. $90,000 you could have access to within 5 to 7 business days, no questions asked. So that creates a bunch of opportunities. So that's for the financing part. We got a case study. We're going to look at Dave, who is age 40, business owner, started really young, 20 years old. Right now, he's generating $350,000 of net annual taxable income, and he was a very savvy investor. He placed his money from an early age, and right now he's at 1.5 million in investments, earning 6% a year, which gives him $90,000 of passive income. Now, Dave's objectives, he had 3 of them. One of them was access to and reduced cost of financing. The other one is he wanted to reduce corporate taxes. And the second one, he wanted a comfortable retirement at age 65. So let's look at the financing portion. Now, you can see the annual premium here. The number that is here, this is for my example. That number could be 10,000. It could be 500,000. It really is dependent on your needs and your capability. So this is just an example. That number is not to scare anybody, but it's just to see for this specific situation. It's a number that I chose that is very representative of what a possible case could be. But those numbers would be evaluated personally, individually, with each one. There'd be an analysis done, and that number would be determined based on your capabilities. So Dave, what he's going to do, he's going to transfer. This is not $100,000 that he has to put out of his pocket. He's going to take from this $1.5 million investment that he had. He's going to draw down $100,000 a year, take it out of the investment, and put it into a whole life insurance contract. So he's going to do that for 20 years only. After 20 years, there's no more payments to make, and his policy keeps growing. So what happens? First 5 years, he puts in $100,000. But right in the first year, Dave says, okay, I need a vehicle. I need a $50,000 vehicle. He puts in $100,000. He would have access to more than $50,000 5 to 7 business days after making that first year premium. So he would borrow $50,000. He would go pay for that vehicle. And the payments he would have made to the financing company, he's simply going to return it back to the life insurance company to pay back his policy loan. So if we look at the first 5 years, he's going to put $100,000 a year. He gets a $50,000 loan, but he makes $12,000. And this is the same amount of payments he would have made to the finance institution. So over 5 years, he's going to pay about $10,159 in financing costs. So that's his total outlays is $519. But if you look, his cash value grew to $518,972. So for every dollar that Dave put into his life insurance policy, including the financing costs, he gets $1.02 in increase in cash value. Now, what gets interesting is year 6 and every 5th year after that, Dave says, I've got this piece of equipment that I need that has to be replaced every 5 years, and it cost me $300,000. So Dave's going to do the same thing. He's going to say, okay, I'm going to borrow against my policy. I'm going to go pay my piece of equipment $300,000. It is mine. There's no lien on it. And I'm going to make the same payments I would have made to the financing company. I'm going to put it back into my life insurance contract. So at the end of 5 years, he's got no more outstanding debt and he has access to all his cash value. So now his financing cost increase, it's six times what the other one was. So it's going to cost him total outlay, including premium, minus the loan, plus the interest is 560,952, but his cash value grew. So that in that 5 year period, every dollar he put in, including financing, he gets $1.23 out. We do the same thing. We rinse and we repeat. After year 15, he put the same amount in, but he's at 1.52. And after 20 years, he puts the same amount, we're assuming the same interest rates, same piece of equipment, and he's getting 1.94. But what is really, really interesting is that in year 20 and beyond, there is no more premium to pay. There is no 100,000. So Dave, because he borrowed $300,000 from his policy, it cost him $60,000. The only cost is his financing cost, but look what happened to his cash value. So for every dollar he put in to finance that piece of equipment, he gets $16.89 out. And one thing really interesting, as I mentioned, there's guaranteed growth. By contract, at age 100, if you look down at the bottom here, at age 100, by contract, the cash value must equal the death benefit. So if Dave lives to 100 years old, his cash value will be $22,065,000, which is equal to his death benefit. And that is by contract. So you can see my death benefit is increasing continually, and my cash value is continually growing to make sure that at age 100, the two of them are equal. So that's why it's guaranteed to growth. It can't go down, it can't go backwards, it can only go ahead because the life insurance contract stipulates that at age 100, the cash value must equal the death benefit. And again, this is a lot of information I'm throwing, but it gives you an idea, and we can look at this in specific situations. But just to give you an idea what the potential is. So we can see that Dave, he can finance things and his money is growing more than the interest it's costing him, even when he's paying it to the life insurance company. So can your business self-finance? Yes, we just saw, as I mentioned, that Dave was able to not only finance things, but his cash value was growing more than the actual borrowing cost. Now we're going to look at, can I reduce my corporate taxes due to passive income? So for those of you that might not be familiar, before 2019, okay, a Canadian controlled private corporation was allowed to generate up to $500,000 of net taxable income and be able to pay the small business tax rate. And in Ontario, this varies by province, but in Ontario, it's 11.5%. So this line was flat. Before 2019, this line was flat. It doesn't matter how much there was no rules regarding passive income. But in 2019, the government says, you're very successful. You're making too much money with your investments in your corporation. You've got an advantage. We're going to take some of that away from you. And what they did is they said, if you're allowed to generate up to $50,000 of passive income within your corporation, and you're still at the $500,000 small business deduction, and anything above that, you're taxed at the general corporate tax rate, which in Ontario is 26.5. So after $50,000, every dollar that I have in passive income above the $50,000, I reduce my small business deduction limit by $5. So it's a 1-to-5 ratio. It's huge. So we can see that anybody that's generating $50,000, he's allowed, but $50,001, but he's going to be $5 less. So anybody that's generating $150,000 of passive income, and I'm sure there's some business owners in January 2019 that were in this situation. Overnight, they had to pay all their business revenue went from 11.5% taxation to 26.5%, just because they were successful, they had invested, and they're making passive income in their corporation. And that's the law. They couldn't change it. That's a law that came out, and they were stuck with that. So if we look at the example in Dave's case, he was generating $350,000 of net taxable revenue, and he was generating 90,000 of passive income. So 50,000, 90,000 minus 50, so it's 40,000. But for every dollar of passive income above 50, so it's 40,000 times 5. So he went from a $500,000 small business deduction limit to a $300,000. So the first $300,000, he pays the small business tax rate 11.5, but the remaining 50,000 or anything above that, he's paying 26%. Now we'll see this in tabular form, but this just gives you a picture And you'll see that if you do nothing different, if Dave does nothing different, his investments are going to increase because they're making 6%. And that's eventually he's going to reach that point where all his revenue will be taxed at the general tax rate. So more than twice of what he's accustomed to pay on all his business income. So this is if Dave does absolutely nothing. Again, we've got $350,000 of net taxable business income. We've got 1.5 million. The small business reduced tax rate is 11.5, and the general corporate tax rate is 26. And as you're probably aware, any investment that you do within your corporation is taxed at least 50%. There's no benefit to investing in your corporation. You're going to pay 50% tax and the investment rate of return. So we see this 1.5 million, it's increasing in value. The taxable gain is increasing, and the tax on the gain is increasing. And we can see here the amount above 50K is increasing. And what is interesting, at year 19, he's generated about $153,000. So that means I'm above 150. So we can see here, he's got no more small business tax. All the tax that he's paying is all general corporate tax rate at 26.5% as opposed to 11%. So the total tax over 25 years, if Dave does nothing, just let his investment grow, his total tax burden will be $2.508 million. If he does nothing, he just lets things ride. Eventually, he's going to move over on that curve, and all his business income is going to be taxable at the general tax rate. So that's a fairly substantial amount. Now let's see what happens if Dave does the recommendation that I did. He's going to transfer $100,000 from his investment into a life insurance contract. So you can see here his investment balance is reducing, is decreasing. Why? Because I'm pulling money out, but it's going into something else. We'll see what the value is of that. His taxable gain is reducing every year, and the amount of tax on the gain is actually reduced every year as well. And if we look here, year 11, he's recovered the whole 500,000. So not only if he does nothing, he's going one way to increase his general tax, and if he goes the other way, he's recovered all his 500,000. So he's only generating 350, but if his revenue did increase to 500,000, on all that 500,000, he would pay the reduced tax rate of 11.5. So we can see that he reduced that simply by changing his money from one place to the other. So the total tax bill, if he was to implement this, because we can see here, we only pay the general corporate tax rate for 2 years. After that, it's all small business taxes. So the effect is, essentially, he would pay 1.2 million as opposed to 2.5. So we look like at $1.3 million over 25 years. I'm not sure about you, but I think I would rather my family have access to that 1.3 million than the federal government. And that's what this can do. Yet he didn't make any more money. He didn't cut his expenses. He simply put his money in a different vehicle that is more efficient, and that gives him a lot of benefits. So he recovered the entire $500,000 small business deduction limit. He transferred taxable assets to non-taxable assets, which was able to reduce the taxes over 25 years by 1.3 million. Now, Dave's objectives, we saw that he was able to finance and have access to financing and reduce the cost. He's able to reduce corporate taxes. And finally, we're going to be looking at saying, can Dave retire comfortably at age 65? So what does Dave have in his private system at age 65? Well, he's got a cash value of 4.18 million. He's got a death benefit of 7.412 million. Now, what can Dave do with this to retire? Well, Dave's going to go to a third-party lending institution. He's going to say, listen, I've got this life insurance contract with a cash value of almost 4.2 million and a death benefit of 7.4. It's all paid up. I have no more. It's all paid up. It's been paid for 5 years. And I want to take a loan every year. Now, this is a corporate policy. So what's the lending institution going to do? They're going to go through their due diligence. They're going to do a credit check. They're going to do all that stuff. That you can't avoid it because we're going to a third-party lender. But what does that mean? That means the lending institution is going to make an annual loan to Dave Inc., to his corporation, of 197. With these numbers here, we calculated that would give, with an interest rate of 6.5%, he'd be able to take a loan, an annual loan of 197. So his corporation, Dave Inc., would receive 197,520 every year from the third-party lending institution. Now, Dave Inc. would send a taxable dividend to Dave Personal of 197,520. So Dave would pay tax on that, assuming a 40% tax bracket for dividends. Dave would receive 118,512 every year clear of taxes. So he receives $197,000 dividend, but he pays tax on it, and net in his pocket would be 118,512. Now, if Dave was to pass away at 65, he would have a net amount to shareholders of 6.6 million. And there's also the capital dividend account of 5,760,000. Now, this capital dividend account is very interesting because this allows this would allow remaining shareholders to pull out up to $5.76 million out of the corporation if there's other assets that were sold. Those could be extracted from the corporation tax-free through a capital dividend up to $5.7 million. That is something that in the US, they do not have this. In Canada, that is a really, really powerful benefit. So looking here, again, we're looking at the policy cash values. Davis finished paying this 5 years ago, but look at the cash values. They're just increasing. They're increasing from age 65. The loan is the annual loan from the lending institution is 197, and there's interest to be paid on that. So nobody's going to lend you money without interest. So you can see the outstanding end of year loan balance is increasing continually, but so is the death benefit and so is the cash value. But Dave, he's always getting the same amount, assuming the same taxation rate. He's getting 118,512 every year. So the death benefit we can see is increasing. It's increasing. The capital dividend account is increasing. And what's interesting is that at age 82, again, this is a lot of detailed information, but just to let you know that the capital dividend account is equal to the death benefit from that point on. And that becomes very, very interesting, and I'll explain that. So the net amount to shareholders, we can see it's increasing. Oh, and then it starts dropping. Why? Because the loan interest is increasing. My money's growing, but I have to pay that loan back. So eventually, if Dave was to pass away at age 89, he's got an outstanding loan of $12,387,000. He's got a death benefit of $15,594,000. So that would mean 4.207 net to shareholders with a CDA, a capital dividend account balance of 16 million. So what does that mean? From 65 to age 89, Dave would have extracted tax-free 2.962 million. Net amount to shareholders after his death would be 4.207 million. And the capital dividend account balance would be 16 million, which means he could pull out up to $16.6 million of other assets that could be sold in the corporation that could be taken out through the capital dividend account tax-free. Now, there's some post-mortem strategies that business owners can establish with their tax attorney and with their accountants that could actually optimize that situation. But this is just strictly looking at life insurance. There's other things, and we can work with a team of professionals that you may have to optimize these situations. But this is just strictly looking at life insurance. So what has Dave accomplished at his passing at age 90? Again, he's got a death benefit of $16,594,000. He's got a loan repayment to the financial institution of $12,387,000. So he pays that off, leaving a net amount of $4.2 million to shareholders tax-free. But during his retirement, he pulled out $2.92 million tax-free in his pockets over that period. And the corporation is left with a capital dividend account of $16,594,620. So you can see that there's so much flexibility. He financed over 20 a period, 1.2 million over a bunch of years. He was able to reduce his taxes, and he's able to pull money and leave money to his heirs, very substantial amounts. So let's look, and we're just to finalize. Did Dave meet his objectives by becoming his own banker? He was looking for access to and reduced cost of financing. He was able to finance 1.25 million with a growing cash value. The money he made, his policy grew more than actually the interest he made. So every year, and it got bigger and bigger as he went along. So that's done. Reduced taxes from passive income. Well, he paid 1.3 million less in corporate taxes. So I think we'll have to say yes to that one. And finally, a comfortable retirement at age 65. Well, he received personal net dividends over that 25-year period from 65 to age 90 of 2.92 million. He left 4.207 million net to shareholders and a capital dividend account balance of 16.5 16.6 million approximately, which means that any assets in the corporation could be pulled out up to that amount tax-free to the remaining shareholders. So I think that pretty much sums up. I think we were able to cover those three requirements or the three objectives that Dave had simply with one policy. This is one policy. Now there's possible to have a system of policies, but this is just one policy that Dave put in place. He was able to accomplish all those things. So that's pretty much the information. And for those that would be interested in seeing if this could work for your business, you can either scan the QR code to schedule an appointment. You can email me at mark@fshgfinancial.life, or you can call me at 613-298, or you can reach out to NOBEEP as well and they can forward the information. So I hope that this information was useful to you. And again, it's a lot of information. It's really condensed. But what I like to do is to sit down with people, find out what their objectives are, what their needs are, and then prepare solutions for evaluation to see if this could be something that could be beneficial to your corporation, to your business. And again, we can look at the whole situation. We can look at corporately. We can look at, personally, you probably have, spouses and children and stuff, and there's a whole bunch of strategies that could be done. You combine, as I was mentioning just before we got online, I do have a corporate policy and I do have a private policy as well. So I'm doing both, and there's advantage to doing that, but not everybody's the same. So my goal would be to, if you have any interest in this, my goal would be to evaluate your current situation and potentially provide solutions for your evaluation to help you obtain some of the objectives that we saw that Dave was able to attain. So that's it for me. Thank you very much for your time. It's really greatly appreciated. And again, there will be another session in French. I will be doing another one in French. I believe it's Karen. I think was it the 11th of June?
June 11th.
Yes. So it'll be the same information, but it's translated, and we'll be doing that one in French. So thank you very much for your time. Greatly appreciate it. I don't know if there's any questions, but I'm open to any questions if there are any. Thank you very much.
Thank you so much, Mark, for this informative and practical presentation. And I think we went over the time. And if you have any question, you can just send them to us at info@nobeep.ca, or you can go ahead and, okay, I see there's one question here. Okay, you can go ahead, Chris.
Hi, Mark. Hi, everyone. Thank you for sharing this good information with us. I would like to know, let's say if I buy my personal car, but I do use it for my business. So now if I want to switch my personal car and then put the lease under my business, under my company, if it is possible that I can get it done, because I do know if you already have your personal car, and then if you want to transfer the lease, you need to pay off.
Yes.
Before you can transmit it.
Yes. There's a couple. There's yes, because it's two separate entities, right? I'm an individual and there's a corporation. And when it comes to especially vehicles, if the corporation owns a vehicle, there's cost associated with that because it's a benefit to the owner. So what I would recommend, and again, I'm not, like I said, this is not tax advice, but what I would recommend is maybe to speak to an accountant to find out what the possibilities are, because sometimes there might be things we're not aware of. But so that's why I would recommend that you speak to an accountant to see, because doing the policy, whether it's in corporate and stuff, you can buy a car, you can stuff, but it's how that's going to be treated by Revenue Canada if you do buy it in your corporation and you possibly use it personally, or if it's transferred from one place to the other. So I would recommend that you speak to your accountant to find out what the best scenario would be.
Perfect. Thank you.
You're welcome.
There's another question there.
I think it was
maybe the last one. Faisal, you can go ahead.
Yes, thank you, Mark, for your time. I won't take much of your time. My question, I do have a few questions. So the first one is just like to know if the process works also for, like, is it just for corporation, or is it just like it can also work for sole proprietorship?
It definitely works. It works for an individual. It works for a family. It works for sole proprietorship. It works for a corporation. Yes, there's again, what I just showed here is there's a lot of benefits to the corporation, but there's something like the capital dividend account for sole proprietorship does not exist. That's strictly in a corporation. But the same advantages in terms of financing, in terms of using your policy as collateral for retirement. Yes, it's good. It works for sole proprietorship for an individual. You can have a family banking system for children as well, with all the same benefits. Yes.
Okay, so if it's a corporation, let's say, so you take the policy under, let's say, under your name, but it's tied. You use the corporation as collateral, or
no? You actually, the corporation would become the owner of the policy.
Okay.
And you would be the life insured.
Okay.
So that's why when I showed when the corporation goes out and gets a loan, the loan is paid to the corporation, and then the corporation makes a dividend payment to Dave.
Right.
Therefore, there is the taxable event that happens there, but there is still an amount that is tax-free. So again, in the sole proprietorship, you would not have that possibility. You would have to be a loan to you individually, but it can work. You can leverage a policy for retirement, whether it's in a corporation, a sole proprietorship, or individually.
Okay, so last question. So corporation can be you can receive a salary or like dividends.
Yes.
So what is your recommendation? Like, do you recommend, let's say, you recommend people to, let's say, put all their, let's say, dividends or salary into the policy, or just like just put the net profits into the policy?
Well, yeah, you'd have to take a look at, because the thing is, if you take your salary, then it's after tax dollars, right? Because any money that you take, whether it's a dividend or salary, you will be taxed personally on that. So if you take a policy, and one of the benefits of having a policy in a corporation, I've got both. There's advantages, but one of the best advantages is that when your corporation pays for the policy, it's taxed at a much lower rate. Therefore, you have more money. So let's say if I was to take a $10,000 policy, just an example, in my corporation, I would take $10,000 out. But to have that same $10,000 policy personally, and I'm getting paid for my corporation, I would probably have to pull out $15,000 because I have to pay tax on that amount to end up with $10,000. So that's why it's efficient. But again, I have both, and there might be reasons why you want to do that. Now, how, in terms of dividends and or salary, again, that's more of a question with your accountant, depending on, some people, if they want to maximize their RRSP contributions, well, if you take just dividends, you can't do that because that's not recognized as a salary. So you'd have to take a portion of salary. So it really depends on every situation, but we can evaluate that individually with each individual case, and we can take a look at what the best scenario is.
Thank you. I appreciate it.
You're welcome.
Thank you so much. Thank you to everyone for your participation and for your beautiful questions. And I know that you still have more questions, but time is running. If you can send the questions to info@nobip.ca, or you can directly contact Marc Lalonde, and he will be more than happy to assist you.
Absolutely.
Okay, and the French version will take place June 11. You're more than welcome, and if you can share with your Francophone network. Okay, I think that's it for today. And thank you so much, Marc, for your beautiful presentation, and to everyone, I wish you a beautiful day.
Thank you very much. Have a good afternoon.